The ship that couldn't sink did. What happened next rewrote how the entire world insures risk. April 10, 1912. Southampton, England, the RMS Titanic leaves dock at noon. She displaces 46,000 tons. She carries 224 passengers and crew. The shipbuilder Harland and Wolff market her as practically unsinkable, not because of perfection but because of her size, her watertight compartments, her redundant systems. The public believed it. The maritime insurance industry believed it too. That belief was about to cost them everything. The insurance market in 1912 operated on assumption, not data. Ships were insured based on vessel age, cargo value, and route. The Titanic's maiden voyage was considered routine low risk. Her insurance premiums reflected that assumption. Underwriters at Lloyd's of London and other syndicates had underwritten thousands of vessels without incident. They had no reason to believe this crossing would be different. April 14th, 11:40 p.m. The ship strikes an iceberg in the North Atlantic. The collision happens at 22.5 knots. The iceberg is dark. There was no moon. The lookouts in the crow's nest had no binoculars. They were locked in a cabinet, and the officer with the key had left the ship in Southampton. None of the crew knew yet that the ship would sink. The collision opened the hull to the sea along a 300-foot gash. Water poured into 6 compartments. The ship had been designed to stay afloat if 4 compartments flooded, not 6. Captain Edward Smith did not immediately order evacuation. The passengers did not initially understand the danger. Many refused lifeboats. They believed the ship itself was safer than a small boat in the cold Atlantic. 2 hours and 40 minutes after impact, the stern rose into the air. The ship's back broke. At 2:20 a.m., the Titanic went under. Of the 224 people aboard, 503 died. Most were passengers in third class or crew. The lifeboats carried 710 people, less than a third of those aboard. The ship that couldn't sink had sunk completely. The financial damage was immediate. The Titanic's hull was insured for £100,000, roughly $3 million in today's money. Her cargo added another £420,000 of claims. But the real cost came from liability. Families sued, survivors sued. The White Star Line, Titanic's owner, faced ruinous exposure. The insurance syndicate that had underwritten her faced collapse. April 1912. Within days of the sinking, inquiries began in both Britain and America. The U.S. Senate inquiry, led by Michigan Senator William Alden Smith, examined 517 witnesses over 36 days. The British Board of Trade inquiry followed. Both investigations revealed something the insurance industry had not quantified. Human error, design flaws, and inadequate regulation were not rare exceptions. They were embedded in maritime practice. The inquiries documented specific failures. Titanic had 20 lifeboats, enough for 178 people. Regulations required lifeboats only for 940. The law was written for ships half Titanic's size. No one had updated it. The ship's wireless operators worked for a private company, not the ship, and prioritized passenger messages over distress calls. The nearby ship Californian had shut down its radio for the night. These weren't mysteries, they were policy gaps. By 1913, the insurance industry faced a reckoning. Underwriters had priced risk based on vessel type and age. They had not priced for design defects, inadequate safety equipment, or crew negligence. The Titanic loss showed that assumption-based pricing was bankrupt. They needed data. They needed standards. They needed a way to measure and enforce maritime safety before ships left port. The solution was the International Convention for Safety of Life at Sea, SOLAS. Adopted in 1914, it mandated lifeboat capacity for all passengers, 24-hour radio watch, ice patrol in the North Atlantic, and mandatory safety inspections. Ships that didn't comply couldn't be insured. Insurance companies became the enforcement mechanism. Underwriters would no longer insure a vessel without proof of compliance. This was a structural shift. Before Titanic, insurance companies reacted to loss. They paid claims and moved on. After Titanic, they became active risk managers. They set standards. They conducted inspections. They refused coverage to non-compliant vessels. The market transformed from passive indemnification into active loss prevention. The pricing model changed too. Insurers began collecting data on vessel age, maintenance records, crew training, and captain experience. They differentiated premiums based on measurable risk factors. A well-maintained ship with a trained crew paid less than a neglected vessel with an inexperienced captain. Risk became quantifiable. Price reflected reality. This model didn't stop at ships. The insurance industry applied the same logic to factories, buildings, and later automobiles. Underwriters began sending inspectors to assess risk before issuing policies. They required safety upgrades as conditions of coverage. Insurance became a tool for enforcing standards across entire industries. The Titanic loss created the template. There's a deeper pattern here. Before Titanic, insurance companies treated risk as unknowable, something to price high and hope for the best. After Titanic, they treated risk as manageable, something to measure, standardize, and prevent. That shift from acceptance to intervention changed how modern economies function. Insurance stopped being passive and became prescriptive. The White Star Line survived financially. The insurance payout and settlements cost them dearly, but the company continued operating for decades. What didn't survive was the old model of maritime insurance. The assumption that size and prestige guaranteed safety vanished. In its place came inspection, data, and regulation. The industry learned that preventing loss was cheaper than paying for it. Today, when you buy insurance for anything home, car, business, you're living in a world shaped by Titanic. The inspection before you get a policy, the safety requirements, the risk assessment based on measurable data, all of it traces back to 1912. The disaster didn't destroy the insurance market. It rebuilt it on a foundation of prevention instead of luck. The gap between what people knew and what would happen, that gap killed 503 people. The gap between what insurers thought they understood and what they actually did understand nearly destroyed the insurance industry. The solution wasn't better guessing. It was data, standards, and enforcement. That lesson embedded itself into every insurance contract written since. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to see how other disasters rewrote the rules of risk. There's a new case every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.